Hi, everyone. This is Danny Cunningham alongside my partner, Brian Kwasnick. We are with the Carr Cunningham storage team of Marcus and Millichap. We're sitting here in our downtown Fort Worth office with Mallory and Aaron Holtgren. They have joined us today to talk about some creative deal structures that we're seeing out there in the marketplace. Obviously, the high interest rate environment has made it increasingly difficult to get deals done in today's investment sales market. So we wanted to talk with two folks who are actively in the market, looking to buy, looking to sell, looking to refinance. You guys are always seeming to be in the mix. So thank you for joining us today, first and foremost.
Thank you for having us.
Absolutely. So, we were just talking about how a little over a year ago, our team kind of read the writing on the wall that interest rates were going up and they were not going to come down anytime soon. So we started exploring some creative deal structures with some of our clients. And the first one that we introduced to them, or I guess reintroduced, was the thought of seller financing. We had some success on a couple deals, and nowadays it seems like seller financing is a conversation that we make sure to have with every single one of our clients on a regular basis. And conversely, around the same time, when we brought a few properties to market, you were also kind of at the forefront of the creative deal structures. And every time you would submit an offer, you would have 2 or 3 different options for our clients to review, whether it was just a conventional offer with bank debt, or it was seller financing, or a kind of pref equity type of structure. You guys were willing to get creative, and I think that's really helped you guys over the past 12, 18 months. So with that said, if you wouldn't mind introducing yourself and letting folks know who you are and what you guys are seeing out there and what you guys are trying to do in the acquisition front.
I'm Mallory Holtgren with Tango Development. I am the Director of Operations, help with the underwriting, the brokerage side as well, and also just making sure everybody does what they're supposed to do in a transaction. I implement, so why don't you touch in on?
Yeah. Thanks for having us. Aaron Holtgren with Tango Development Services. We are a storage acquisition development company in the North Texas area, and our footprint is basically Texas, Oklahoma, and we're looking to expand that and really like that market. We started in about 2020 as Tango. Before that, I had grown a development acquisition company in the Midwest from $0 in assets to around $500 million in assets. Exited that and then started Tango. So we've been around for a little while and are really excited about this market. Our acquisition strategy is basically figuring out creative ways to put deals together. Like you guys had said, this marketplace is rather challenging right now, and we are the days of here's your cash offer, take it or leave it is kind of gone, and we've really reverted to more of a here's a couple options that work for us, and that has been very promising for us moving forward and whatnot. So that's really been our storage strategy, and the forecast, I think, is really interesting for people that want to put deals together, whether that's from a selling side or from a buyer side.
Mm-hmm. Completely agree. So as I kind of alluded to, seller financing seems to be the most common route that we're seeing these days. As a couple folks who are seeing a ton of deals come across your desk on a weekly basis, what kind of rate and terms are you typically seeing in self-storage listings? And I guess also, what do you like to see? And then I'll leave it with kind of what are the pros and cons of seller financing in your opinion?
Yeah, I would say that when we're looking at an opportunity, they're all over the board. But there's one general rule that we are seeing, and that is that sellers are generally able to obtain a higher sale price by offering a below current market interest rate, right? and whether that interest rate is 5% or 7% or 4%, it's really all over the board, and it's kind of directly correlated to what they want for that top sale price, right? So they're all over the board, and I think there is no common message to it right now. But I think what are we looking for? We're looking for opportunity, right? So for us, it's not as hey, it's the seller financing has to be at 6%, right? It is once we model the deal and figure out the opportunity, what makes sense.
Okay. So what are some of the pros and cons, in your opinion, for both a buyer and a seller standpoint for
Totally.
owner financing?
Yeah, so I'll start from a seller first, right? The seller oftentimes is able to obtain an acquisition price that no one else in the market could pay right now, not with a traditional, cash or bank financing scenario. They're not going to get that price. So they're able to obtain a higher price than they conceivably would otherwise. There's other ancillary benefits that a lot of times sellers don't think about, and that is tax benefits. I'm not a tax planner or CPA or attorney, but a deferred sale clause, as the IRS looks at it, they're only going to pay taxes on the portion of that gain that they're paid in that given year, right? So instead of having to cut a monster check to the IRS, you can cut some smaller checks to the IRS, and if they're smart and they're working with their CPA, they can figure out how to stay in certain tax brackets with the income portion, which is interest, versus the capital gain portion, and really maximize their tax benefits. So that is really, between maximizing sale price and maximizing tax benefits, that's really the two big standouts from a seller standpoint. From a buyer, obtaining terms that are not, are next to impossible in the existing banking environment is really the catch-22 there, the catch-all, whether that's rates, right? Being able to obtain rates that are below current market, whether it's leverage points that the banks aren't offering that are now able to be offered. So those are the two big things, and like any good investor, figuring out how does that impact return, and that really helps.
Yeah, definitely. You mentioned loan to value, which is something that we're seeing more and more and hearing from other buyers and investors that's become more challenging. That traditionally you're looking at 75, 70% LTV, and that can now change. I'm hearing 50, 60%. In addition, banks are asking for deposits, which seems to be a new thing now. Going forward, how have you kind of been adjusting to that environment? You're raising capital for your deals. Any strategies that you've implemented to try to deal with all of those things that have come up?
Yeah. So for us, we typically syndicate deals, right? So we're going out to a group of investors, and sometimes it's small, sometimes it's large groups, and raising that capital. So one of the things that we've done is not only getting creative on the buy side, but we're also getting creative on the backside, our side of the things, where we're going to the capital markets. We've implemented different classes of ownership, right? And maybe you can talk about the two different classes on our most recent deal.
Yeah, there has been some times where we can get the seller to put, what part of the proceeds of the sale would be back into the deal, and they'll get, a part of ownership for that, and they'll also get a pref on whatever amount that they retain back in the deal.
Yeah. So like Mallory was saying, it's part ownership contribution plus some of our capital dovetailed next to each other in order to combat that loan to value issue that you were talking about.
Now, one question that we oftentimes get from our clients is, hey, I would like to do seller financing, but I have a loan on the property and I just don't know if the down payment from the seller would be enough to pay off my mortgage. So in those scenarios, is there still a way to get a deal done?
Yeah. One of the things that's been really effective for us in the past is doing more of a lease purchase option where where we don't violate any of the bank covenants, right? Because there's an assignment of rents, right? So they're still renting the asset out. So we would make a rent payment to the seller, and that rent payment could be all rent, or a portion of it could go to pay down the principal balance of what the agreed upon exit is, the exit sale price, for some specified period of time. Oftentimes, before any maturity date on the seller's existing debt. And then, then at that point in time, we've worked our business plan. Hopefully the value is increased because the plan works, and we're able to execute and pay them the full price of whatever was agreed upon, which then pays off their principal debt.
Okay, so it basically works the same way as seller financing. It's just structured a different way.
Correct.
It sounds like.
Absolutely.
Perfect. So one other thing that I wanted to touch on, when Brian and I are meeting with our clients and trying to advise them, one of the biggest things that we're trying to figure out is, what is their motivation? What drives them to do the things that they do? And from a seller standpoint, there's typically 4 kinds of motivators. There's price, there's problem, there's another opportunity that they'd like to go pursue, or there's a change in their lifestyle. Maybe they're tired of the day-to-day responsibilities, or maybe they're nearing retirement. So what type of sellers are you targeting with your creative financing, or creative deal structures in today's market? Because I know from our standpoint, the people who are just trying to chase the highest price on a conventional sale, we're oftentimes telling those folks, you're just going to have to wait until things get back to a normal interest rate environment.
Yep. So I would say it's the 3 problems outside of price that you guys specified are the opportunity, right? Where if they've got a change, they've got a problem, or they are looking to go find another or do something different. Those are the 3 caveats that we can help with. We're looking for the sellers that they are ready to part with the property, right? They're ready to move on and do something else, no matter which of the 3 options it is. They're looking for creativity in terms of structure and tax benefits, right? Because all we can accomplish for the 3 sellers outside of price, we can accomplish generally all of their needs through some creative structure, utilizing some of the things that we talked about, and get to an end game where they can move on, they can move to a different opportunity, they can enjoy retirement or whatever the case may be.
Okay. And it sounds like it doesn't even have to be a seller with little to no debt, because there's so many creative ways that you can even work around that. It kind of fits for everyone.
Absolutely. I think that's the biggest misconception about any type of seller financing, especially in the commercial space, is I have to own my property free and clear, which isn't the case. Somebody just hasn't got creative enough yet to figure that out.
So one of the most common ways to structure a deal in today's environment is through seller financing, as we talked about earlier. What are you seeing out there in terms of listings and marketing packages from other brokers in terms of interest rate being offered, loan to value, and kind of term, interest only period potentially? What is kind of the most common thing that you guys are seeing from your standpoint? And also, I guess, what does the ideal opportunity look like?
I think that's twofold. One of the things that we're seeing is I think we're seeing a lot of brokers maybe buying listings, coming out with unreal expectations with their clients to get a listing sold, and that's one issue that we see. The other issue we see is a lot of more creative financing, right? And those creative financing terms vary across the board, from lower interest rates to higher interest rates to higher leverage points on what they're willing to offer, and it is there is no consistency in it. It's just all over the board.
Okay. So what is the ideal scenario look like for you guys, and what are some pros and cons for both buyer and seller to seller financing?
Yeah, our ideal situation is for lack of a better term, something that makes sense, right? We're looking for opportunities that allow us to achieve certain metrics and get returns to our investors, whether that's higher leverage points and lower interest rates, or lower purchase prices in general for just cash transactions. So for us, it's very opportunistic in what makes sense. I am super excited for the future, right? I was in this business in 8, 9, and 10. I seen how deals got put together, how people that could get creative got excited about the market, then really capitalized on it. From a seller standpoint, we did great deals. From a buyer standpoint, we did great deals all through the Great Recession, right? And not that we're at the Great Recession, but we are seeing slowdown in the economy, and it has me super excited as a buyer and as a seller in both shoes, because there are opportunities in both.
So it sounds like the biggest takeaway is there's just no one size fits all answer to any deal, but as long as you've got a buyer and seller willing to get creative, then there's probably a successful win-win deal to be had, which is great news, I think, for everyone looking to buy and sell self-storage over the next 12 to 18 months. So Mallory, Aaron, just want to say thank you guys so much again for taking the time to join us, and look forward to working on some more deals together in the future.
Absolutely.
Thanks for
Thank
having us.
you.
We're excited.
Thank you.